A very good morning, afternoon, or evening from Nairobi. Thank you for joining us from wherever you are in the world. My name is Edward Obiko, a specialist in digital financial services at MSC. I will be your host for today's webinar on investing in the agents of change. MSC has recently conducted a study to understand the capital and funding requirements of cash-in and cash-out agents across 9 countries in Asia and Africa. This study was graciously funded by the Financial Services for the Poor team at the Bill and Melinda Gates Foundation. The study reveals a huge market gap and opportunity to provide startup, working, and growth capital to agents. Today, we will launch this report through this webinar. We have arranged a great lineup of guests that include investors, financial service providers, and startups that are lending to cash-in and cash-out agents. I'm joined by Mr. Anup Singh, a partner at MSC who helped to conduct this study. He will give us our opening remarks on the study and what to expect in the detailed report. After Anup, we shall have a keynote address from Mr. Seth Garz, a senior program officer at the Bill and Melinda Gates Foundation. Mr. Raunak Kapoor, a specialist in digital financial services, will give a detailed summary of our report findings, after which we shall have a panel discussion moderated by Mr. Akand Tiwari. Welcome once more. Let's have our opening remarks from Mr. Anup Singh. Over to you, Anup.
Edward. Hello, everyone. Welcome to our webinar on investing in the agents of change. It is my pleasure to open the proceedings. Agent networks bridge the needs of the unserved and underserved with digital financial services by enabling the conversion of physical cash to digital money and vice versa. Furthermore, cash-in and cash-out agents verify customers and transactions, onboard new customers, instruct customers on methods to conduct digital transactions, convert cash to digital money, and resolve the concerns about payment failures. Thus, agents act as ambassadors on behalf of the DFS providers. They bring customers who are unfamiliar with DFS, who lack access to formal financial services, into the DFS ecosystem. We all understand that agent networks are one of the most critical and complex to manage constituents of DFS systems. Agent network management costs between 40 and 55% of providers' business revenue and is the costliest element of the DFS value chain and ecosystem. Despite the costs, robust agent networks are crucial to successful DFS deployment in any market. Since agent liquidity is one of the crucial drivers of healthy agent networks, we assess lending to cash-in and cash-out agents in several countries in Sub-Saharan Africa, South Asia, and Southeast Asia. The assessment of the agent lending landscape in these countries was funded by the Financial Services for the Poor team at the Bill and Melinda Gates Foundation. We covered 9 countries through our operations in South and Southeast Asia, Anglophone Africa, and Francophone Africa. These countries were Bangladesh, India, and Indonesia from Asia, Senegal and Ivory Coast in Francophone Africa, and Ghana, Kenya, Nigeria, and Uganda from Anglophone Africa. The study focused on assessing the role of financing for cash-in and cash-out agents to develop the digital financial services ecosystem further. We reviewed several agent network management structures and business models across different markets. We assessed the impact of the liquidity challenges on the agents and how it impacts the transactions and users' trust in the digital ecosystem. After that, we spoke to leading experts on agent networks, the lenders who are lending to the agents, investors, and the private equity firms in Africa and Asia. And through this, we were able to gather their thoughts on the opportunity to focus on agent lending. Our analysis shows that an agent loses 1 in 5 transactions to a lack of liquidity. With access to loans, agents could serve the users better with fewer transaction denials. We estimate that lending to agents is a market worth $500 to $1 billion across the 9 focus markets, and these markets would grow to $1.2 to $2.3 billion by 2027 at an annual growth rate of approximately 19%. Raunak, who is going to come later, will be covering more nuanced insights and our recommendations in the next session. Thank you once again for your participation in this event, and we look forward to learning from the panelists. Thank you.
Thank you very much, Mr. Anup. Very interesting learning indeed. The Bill and Melinda Gates Foundation is crucial in guiding and supporting our work. I would like now to invite Mr. Seth Garz from the foundation, who will give us our keynote address. Seth?
Thanks so much, Edward. It's really a pleasure to be here. Before we hear from the experts innovating in this field, I just wanted to take a moment to provide a bit of motivation from our perspective. As mentioned, I work at the Gates Foundation's Financial Services for the Poor team. where we work to drive financial inclusion among those traditionally excluded from the formal banking system. However, for the sake of this presentation, kind of contrary to my normal posture, I'd love to kind of wear my hat as in my former occupation as kind of like a Wall Street analyst to make the point that I think there really is an authentic investment thesis here that I'm really excited that you and your team at MSC have pointed out. So just to start with a bit of kind of like a thought experiment, what if I told you that I had 18 million ATMs, cash machines, that kind of made me money every time someone withdrew funds, but that for roughly 25% of the transactions, they are actually empty without cash so that the transaction failed? What if I then told you that, second point, that I was ready to install millions of new ATMs in new locations based on billions of historical data points on transactions and fees and customer behavior from my existing network, but that I didn't have the cash to set up and install those new ATMs? Third, what if I then told you that the majority of my existing ATMs and potential new ATMs not only made money through transactions when people withdrew cash, but also kind of doubled as coffee makers, right? With customers lining up not just to withdraw cash, but also for espresso drinks and chai. But that many of the customers who were turned away, many of the customers who were in line for coffee and tea were turned away because I didn't have enough funding to keep those machines stocked with coffee and tea ingredients. All right. And then finally, fourth, what if I then told you that the exact location, the manufacturer's ID, the data on transaction fees and the cash flows from them were all available for these ATMs in virtually real time? All right. So with those 4 pieces of information, would you lend me the money to set up new ATMs where there was demonstrated demand, to stock my ATMs with cash, to maintain inventories of tea and coffee beans that would keep the embedded coffee makers buzzing and making money? Could you lend profitably to me against this kind of virtuous start, work, grow kind of cycle of productive entrepreneurial investment? This is really implicitly the central question to the new report from MSC, the central question that the report seeks to address. Of course, the report is not interested in my stylized example of ATM cash machines, but it's focused on the very human 18 or so million plus mobile money agents globally and banking correspondents that are on the forefront of economic growth in developing economies. These are the hardworking folks embedded in local marketplaces and pushing the reach of the formal finance system to new frontiers. People who both lubricate kind of the engines of economic development with these cash in and cash out services, and themselves operate adjacent small and medium-sized enterprises that are credit constrained, despite often having quite high returns on capital. I recently listened to the CEO of a new kind of Amazon-like delivery and fulfillment service in South Asia tell me about the margins that his company makes, providing better payment terms to the small-scale retail clients that he serves. And I asked him, isn't this really risky? Well, it turns out to hardly be risky at all, he suggested. If they don't pay, we stop delivering. We are the exclusive channel for too many of the necessary stocks of goods, he explained. This really should and it can be a direct analogy for lending to mobile money agents. In fact, agents are potential borrowers who are dependent on one or at most a few payment platforms to enable their cash in, cash out business, which, as we will hear later, can either implicitly or sometimes explicitly be leveraged as security to encourage repayment of borrowed funds. So to be clear, agents are not just another kind of MSME microenterprise lending opportunity. They're qualitatively different because of their connection to payment platforms. So to return to where I started with the motivation for my excitement on the release of this report, I think this report demonstrates the large market opportunity for lending to agents and banking correspondents, and provides practical business model kind of case studies for addressing this agent credit thesis, which really begs the question that I will now pose to you as I close, which is, what is needed to scale these solutions and advance the agent networks to a whole new tier of productivity, of profitability, and effective customer service? That's the question I hope you help us, MSC, the Gates Foundation, and our commercial partners to answer. And I very much look forward to the discussion today, and will be delighted to contribute to any discussion that in general helps cash in, cash out agents and banking correspondents with their financing needs. Thank you very much to the MSC team. Over to you.
Thank you very much, Seth, for those very interesting perspectives and questions. Indeed, there's need to make agent networks sustainable. And I think perhaps our next speaker, Mr. Rana Kapoor, will give us some detailed insights from our report that can help answer some of these questions. Ranak?
Thanks, Edward. Can you share my presentation, please? Yeah. So thank you, Anup and Seth, for setting the context very well. Before I start my presentation, I would like to reiterate that our focus was on 9 countries, as highlighted by Anup earlier. So all the calculations on sizing the opportunity was based on the scale of Kiko operations in these 9 countries. Although depending on the individual country's context, some of the findings, insights, recommendations would be relevant for other markets as well. Can you go to the next slide, please? So Kiko, next slide, please. Yeah, thanks. So Kiko agents play a critical role in taking digital payments to the last mile. And across the globe, there are more than 18 million Kiko agents. This includes banking, mobile money, and fintech agents. While there has been some debate on how relevant these agent networks would be in future, given the fast pace of innovations in digital payments, at least in the countries that we looked in this study, we can confidently say that agents will continue to be relevant for quite some time, as large segments of the population may still need their support to transact digitally, particularly in rural and frontier locations, and not to mention the overall economics of setting up an agent vis-a-vis an ATM or a physical branch, which Sid also explained quite well. Next slide, please. Can you please go to the next slide? Yeah, so while some markets are more saturated than others when it comes to agent operations, we believe that all 9 countries will witness growth in agent numbers and consequently the overall volume of DFS transactions processed by these agents. We estimate that across these 9 countries, in about 5 years' time, agents would be processing close to 25 to 37 billion DFS transactions, amounting to 1.7 to 3 trillion US dollars. The numbers throughout our report are presented in terms of ranges, as we took both optimistic and pessimistic scenarios under consideration. We also expect that there will be overall growth in net agent numbers across all the markets within the range of 5 to 30%, depending on the maturity of these markets. And when I say net, I mean the new agents that come into the system, taking into account that some of these new agents would be set up by the providers to actually extend their reach, whereas some may be recruited to replace the churn in the existing networks. And then there would be some agents which will not be replaced and may ultimately drop out of the system. So the numbers in this graph below is net of all these 3 values. Can you go to the next slide, please? So as Anup briefly alluded in his opening remarks, an agent may require credit for 3 distinct use cases. The first is for the startup capital required to set up an agent outlet. Now, this can further be segregated into 2 subcategories. One is the capital needed to buy the required hardware, do the branding of the outlet, in some cases even to invest in securing the premises. The second subcategory is the initial capital required to kickstart the agency business. Now, usually the overall startup capital required to start agency business, at least in non-dedicated models, is not much, as agents can get started simply by downloading a mobile app to facilitate transactions, even with a small amount of capital. However, in certain markets and in certain business models, the regulators or the service providers mandate high upfront investments, which due to lack of financing options could be an entry barrier for an agent to start business operations around DFS. So the total opportunity to lend to the agent for startup investment is around 115 to 241 million US dollars in the next 5 years. In our report, we have also sliced and diced these numbers as per individual country use cases. So those details are there in the full report. And the second broad category is the credit needed for the ongoing liquidity management, which includes investment in e-float or cash as the situation of an individual agent may be. And most of the existing lending models currently target this use case. And the total opportunity for lending for working capital is estimated to be between 433 to 799 million US dollars. And then the last category is the lending for adjacent non-DFS business of an agent. This is the biggest opportunity simply because on an average, what we have seen for a non-dedicated agent, which is the predominant model in most of the markets, DFS revenues are only about 10-20% of their total revenues of the enterprise. So having said this, we believe that lending for the working capital needs would be the pivot for most lenders to start lending to the agents, and eventually they would sort of branch out to other use cases like lending for the startup capital or lending for the adjacent business of the agent. Next slide, please. So across these different 9 countries, the total addressable market for agent lending is estimated at around 500 to 900 million US dollars in 2022, and it will grow at an annual growth rate of 27%. And in next 5 years, the overall market opportunity for agent lending will be between 1.2 to 2.3 billion US dollars. The larger markets like India, Indonesia, Nigeria, Bangladesh account for much larger share of the pie. Next slide, please. So across the markets, the agent lending models that we studies can be classified into 3 broad categories. Next slide, please. So the first model is the in-house model, wherein the DFS provider directly lends to the agents. Now this model is largely adopted by banks as they have the required capital as well as network to lend. Some examples are SBI in India, Equity Bank in Kenya, and Bank BRI in Indonesia. And a slight variation of this model is where a bank may not engage directly with their agents, but may provide credit to master agents who in turn would channelize these funds to the agents. The second model, or the partnership model, is where an agent network manager is lending to the agents in partnership with the lender. This lender could be a bank, an NBFC, or a fintech. And then the third model, what we are calling as independent, is where a specialized lender who's not an A&M, so that's the major difference between the second and third model, is lending to the agents with or without partnership with an A&M or a service provider. So for partnerships, we have example of Bloom in Kenya that partners with Safaricom to lend to M-Pesa agents and merchants. Then we also have example of Flow that lends to agents in Uganda and Rwanda. Flow actually has both the models. One is where they partner with an A&M, and the other is which they approach agents directly, onboard them on their platform, and then collect the data for making the lending decisions. Next slide, please. However, barring these few examples, lending to agents is still fairly limited. In our interactions with stakeholders, we find that there are a few reasons why stakeholders find it challenging to cater to this segment. And when I'm using this word stakeholders, I mean a range of actors from investors to banks to A&Ms and service providers. So the first and the foremost is there is limited understanding on Kiko business, especially on aspects related to liquidity management. In many markets, we've seen providers are still struggling to adequately support agents on managing their liquidity. Also, in general, the overall business potential for lending to these agents is not very well understood. The second challenge is the lack of experience in digital lending, especially for some of the incumbent banks that makes them shy away from lending to their agents. And in case of fintechs and digital lenders, their ability to forge partnerships with A&Ms and service providers is an entry barrier for them. Since A&Ms and service providers technically own the transaction data, their willingness to share that with a lender will define whether that lender can serve the agents or not. And often the revenue and risk sharing aspects of such partnership become contentious between these two parties. There are also regulatory challenges in certain markets where fintechs may not be allowed to lend, as well as figuring out the right license to operate can be a long journey for some of the providers. In countries like Tanzania and Uganda, we have seen such a situation. And lastly, even if potential lender has the ability to lend digitally, has access to agent transaction data, lending to agent is just not on top priority for them, which also links to the first point about lack of understanding on the overall business opportunity to serve the segment. Can you go to the last slide, please? So MSC believes that policymakers and regulators can play a significant role in catalyzing agent lending, especially by creating certain enabling conditions that can encourage service providers to venture into such lending. So first and foremost, a certain blended finance approaches can be considered. This could be in form of explicitly classifying agent lending as a priority sector, segment that mandate the service providers to lend to this segment. It could also be in form of credit guarantee funds that can encourage private sector lenders to lend to the agents. It may also be in form of channeling some of the existing subsidized credit programs for MSMEs into agent lending. We have seen that in a lot of developing countries, such as Indonesia and India, we have programs like POOR and Mudra, which could be channelized to be used for such agent lending. Second is to provide some sort of a sandbox environment for agent lending, especially in jurisdictions where fintech lending is restricted or where getting appropriate lending license may take up a lot of time. And as far as infrastructure enablement is concerned, all the infrastructure that may support digital lending in general is useful, whether it's about digital identity or payments. But specifically in case of agents, some sort of an access to central agent database sitting with the regulators or policymakers would be useful. We have seen examples of regulators that maintain a very extensive repository of agent data, while some other regulators collect the most basic details, which may not be very useful. The larger point here is that if regulators invest in building such a central database, which is in their own interest to supervise this sector better, it can additionally be used to catalyze agent lending as well. And last but not the least, knowledge dissemination on best practices may also help in raising the awareness levels of the stakeholders to serve the segment. Can you go to the next one? And from an investor perspective, I think Seth very well explained the opportunity that is there. But in general, any sort of investment, investors can potentially invest in startups that are catering to this segment. At least on merchant lending side, we have seen examples of how investors have helped fintechs to scale. Investors can also look at providing debt solutions to lenders, given the fact that cost of capital is a major concern for a lot of the non-banks that are trying to serve this sector. And investors can also provide business and networking and partnership support. And last but not the least, some sort of an advocacy support that could be provided on certain policy and regulatory barriers specific to a certain market. So that's all from my end. This is the end of my presentation. Thank you all. A much detailed report is on our website, which is more than 100 pages. And we'd be happy to clarify any doubts that you may have on our report or any comments and suggestions that you may have. Thank you once again, and I'll pass it on to Edward to take the session forward. Thanks.
Thank you very much, Raunak. I think you've set the stage for a very interesting panel discussion. We look forward to reading the detailed report. So let me quickly introduce our stellar guests for the panel discussion. I want to start by extending a warm welcome to Abhinav Sinha, co-founder of Echo India Financial Services. Echo has more than 150,000 agents offering financial services to the underserved. Our next guest is Nitin Garg from Flow Global, a fintech startup offering credit to meet the liquidity needs of small businesses, especially Kiko agents in Uganda. Next, we have Mr. George Maingi, COO of Asante Financial Services. Asante is a credit-led neobank that supports Africa's growth by providing financial services to growing businesses. Our next guest is Jude Mukasa, e-channel manager at KCB Bank, Uganda. KCB Bank partners with Airtel to provide credit to Airtel Money agents. Lastly, we have Charlie Graham Brown, Chief Investment Officer and partner at SeedStars. SeedStars is an international investment and education company that invests in promising entrepreneurs and high-growth companies. Mr. Akant Tiwari, our partner at MSC, is going to moderate the panel. Welcome, Akant.
Thank you, Edward. I hope I'm audible. Welcome to the panel discussion,
Yes.
where we bring this fantastic group of people at the forefront of innovation in Kiko networks worldwide. Thank you for sharing with us some of your precious time today, Abhinav, Nitin, George, Jude, and Charlie. And thanks again to Seth. What a fantastic analogy, and Ronak for sharing the insights from the work. You have helped me by setting the tone of today's discussion. And as you pointed out, I'll actually repeat it. There are more than 18 million micro entrepreneurs who are working as Kiko agents. Still, the vast majority of these agents cannot realize their full potential, nor adequately serve their customers. And this is partly due to lack of access to capital throughout their life cycle. I mean, it's not just one stage. Let me quote some more data points to it. In our past studies, we have found that between 17 to 45% of customers have often said that they were not able to transact at an agent because of lack of e-float or cash. And similarly, at an agent level, one agents mentioned losing 1 in 5 transactions for lack of liquidity. And we see the outputs out there. I mean, the result of this, the latest report from GSMA estimates 55% inactivity amongst mobile money agents. And MSC estimates are also similar. I mean, we do include a lot of banking agents, but they are anywhere close to 30% plus inactivity rates amongst agents. So there is certainly an untapped next frontier in micro enterprise lending. So we'll start the discussion with a quick fire round. So we'll ask a specific question to each panelist, and they'll have a minute to respond. And before I begin, I must highlight that let's use the chat and Q&A window. I see there are already some questions on the Q&A window, but please keep them coming. Our panelists and MSC team will love to engage and respond to those questions. So yeah, my first question is to Jude. In the light of challenges around access to credit highlighted above, how has your partnership with Airtel Money in Uganda reduced agent losses due to transaction denial?
Thank you very much. Thank you very much for the question. In light with that, before we did the partnership with Airtel, a number of agents in the market who are basically towards the afternoon time, evening time, they would run out of value or float to service customers and those who want to deposit. So that triggered more to this partnership. So in this partnership, the agent who is able to rebalance is float or is self of agent loan through using our agent loan facility with Airtel Money. So the agent is able to borrow money off the platform, off his agent line, by simply just dialing *185 *9#. He puts in the value he wants to borrow, because already pre-scored, and he earns that money off his float. When he gets the money on his float on his mobile, he's able to service his next customer. So he doesn't lose the customer in process. So he's able and is equipped to service the next customer in the process. And the beauty about it is that this is a short-term loan of kind that within 24 hours he pays it back. So he uses the funds, and then the following day he can be able to deposit back. So it doesn't lose money in terms of servicing customers. He services the customers. At the same time, he's able to have capital to run with his business until he closes the day off. So that partnership really bridged up that gap we had in the market for those specific agents, and the feedback which is coming through is truly positive. And of course, we have had some other people knock on the door if we can have the same partnership. But this is quite an interesting project to invest in, and it gives agents more capital, more power to serve their customers in different areas.
Thank you, Jude. Abhinav, in your experience, what are some factors that make lending to agents safer as compared to other micro enterprises?
Thank you so much for the question, Akand. In my 15 years of running the agent network, I think the agents who based on that data currently within ECHO are getting underwritten. I think there's a very, very strong umbilical relationship between the agent and ECHO, and as a result of which we understand the behavior of these agents very, very nicely. And I'll give you certain examples. For instance, in order to make liquidity available, let's say the electronic value available for more transactions to happen, different agents want their liquidity in a different fashion. For instance, somebody would, if somebody is trying to do a particular transaction and does not have electronic value, they would like to dip into the credit only for that particular transaction. So even that's credit. Somebody, let's say, there is another kind of credit that we offer, which is a one-day credit, which is, let's say somebody draws down 100,000 Indian rupees in the morning and uses that through the day for business and returns the money at the end of the day. So that's also liquidity, right? Somebody is investing 50,000 or 100,000 Indian rupees themselves, and there is an additional capital coming from ECHO for them to do more business. Somebody is saying, hey, I have enough capital. However, cover me for the few transactions that I may not have capital available. So that's really a small, even smaller size. Certain agents are a lot more comfortable saying that, give me a longer tenure credit for doing the business. For instance, they'll say, give me for 2 days, give me for 7 days. So while each of these products are slightly different than the other, each of them is slightly priced different than the other, but at the end of the day solves for the same thing. So what I wanted to bring out is, it is important to understand the agent. It is important to understand the behavior of the agent. All the agents are attempting to solve the same problem, but the solution is not the same for the same problem for each agent, right? And it is important for network managers to understand that while the problem articulation could be the same for agents in terms of liquidity or cash availability, the solution for each of the agent may not be the same. So I'm just going to take a pause here. That it's super learning, when one has to innovate for different products for the same problem statement expressed by the agents.
Fantastic. Thank you so much, Abhinav. And I think this also partly covers what I had in mind for Nitin. But Nitin, agents need different type of credit, right? But we have heard people say, agents need in cash out. They do cash in, cash out, every time. Why do they need any sort of financing? And we have really heard this in some markets. What's your reaction to this with regards to agents' diversified needs?
Yeah, so before I start, first of all, thanks for putting across this panel. It's so good to see both you and Abhinav, because that is where I started. Learning everything at MicroSave and also at ECHO. So it's good to have them. Now coming back to what you were asking, like why do they need credit? Like if you look at any of these agents, they are not just doing mobile money, right? They have a shop. And it's like a small business which has limited capital to manage like 10 different businesses within this shop, right? So now what they are doing is they are just rotating capital between different businesses that they have. Now, why they need lending for mobile money is to be able to use, like they need capital all the time, especially in the markets where we are. These shops need capital all the time. We are doing mobile money because, first of all, it's a great opportunity. And then the other reason is that there is so much data available. Like I can see every single transaction of this agent, right? And that is what, on the basis of which I lend to them. So they need money to be able to manage not just mobile money within their shop, but also other different businesses that they are doing within their shop. And also, I would like to come back to what Seth said, and I think, as you also said, he set the tone right at the very beginning. We should start looking at these shops not just as mobile money agents, but businesses who do different businesses. And mobile money is just one of the businesses. where we have a lot more visibility. Yeah.
Thank you.
Yeah.
No, thank you, Nitin. Very well summarized. In fact, I mean, Ronak also hinted at it. These shops are businesses and they have multiple needs. Abhinav also alluded to it. But this is quick fire round. We'll come back later with more detailed questions and answers. So I'll turn to George. Asante provides credit to small businesses and has recently piloted a lending product for Kiko agents. So, George, my quick fire round question to you is if you could talk a bit very quickly on the role of technology in increasing lenders' ability to expand into funding Kiko and their adjacent businesses. If you could talk about it.
Yeah, thanks a lot, Akkad, and the rest of the team, Edward, for organizing for this session. And I'd like to appreciate the introduction that Seth did. He actually set the pace for like what we do. And this is very dear to our business in that agents are not just mobile money agents. You know, agents have other businesses around them. You could find that an agent has a shop, a retail shop. It could have, they could have a pharmacy. They could have a chemist, you know, a filling station. So all these are businesses that agents run alongside the agency business. Now, as Asante, we've been doing this business for the last 5 years, you know, the adjacent business financing. And we appreciate very much the role of technology in that technology has played a big role in a few things. Number one is shortening the time a business takes to onboard, to be processed in terms of the loan application, to be serviced in terms of acquiring that cash, and also the channels available for repayment. And I just highlight a few things around technology, comparing with traditional brick and mortar aspect that initially business people had to visit a physical financial service provider, provide documentation and all that for them to be processed, for them to be, you know, told whether they've been approved or not. So for KYC, for example, we provide digital channels, which could be USSD channel or mobile app, depending on the strategic partner we are working with. So that reduces the time to onboard as a business, you know, to a few seconds as opposed to a few days. Then there's the issue of decisioning. You know, because of the channels that are available and the integration to data sources, we are able to do decisioning in near real time, where, you know, in a matter of seconds after a business has onboarded, they're able to know their limits that they have available to take up a loan. Then there's the issue of the KYC validation. You know, we have integrations to databases that you can use to validate KYC information, for example, government databases, as well as CRB. These are credit bureaus that are available within the markets that we operate in. And all these translates into very nice, you know, customer experience. And then it comes to the loan disbursement, okay? After all that process of onboarding, decisioning, comes to the loan disbursement. The loan is disbursed to the businesses. It could be, for example, the till that they use for their business operations in the case of Bloom merchants within Safaricom. It could be to a supplier in case of retailers that are onboarded through FMCGs. In this case, you know, the money is disbursed to the supplier, and then the business gets the goods. So in that sense, as Asante, we're able to say that we are fulfilling the need at the point of need. So in a nutshell, technology has hastened this entire process into just a matter of, you know, a few minutes, if not seconds, all the way down from days, sometimes weeks, by the time a bank, you know, evaluates and processes a business's need. So I think in a nutshell, I can say that technology is a key cog in these businesses that are adjacent to agents, and it will continue playing a big role in the Kiko agent financing.
Thank you, George. And I'll quickly move to Charlie for the last question of the quick fire round. So Charlie, you have heard everybody talking about being a potential in the Kiko network and, you know, the data points. What are some factors that prevent adequate investor interest in the sector? Or if this is a wrong question at all?
No, I think it's a great question still. And I mean, everyone on this call, I would consider, maybe myself excluded, as kind of experts in the space. And, businesses have been doing this for 5 years, but I think your report is one of the first. So the first challenge that I see here that is preventing significant interest is just the awareness. And I think that stems from the fact that this context and what's happening with the Kiko networks is a global South first innovation. It's a good example of leapfrogging, which I think means that a lot of the people holding the capital are just unaware of it. If you look at how much capital is flowing into some of the other business models out there, like payment networks or B2B commerce, e-commerce, neobanks, those are all concepts that have been developed, scaled in more developed markets, the US and Europe and so forth. And so I think the interest of international investors in backing models they've seen close to home is just that much more prevalent. So I think that's the first challenge. It's a leapfrogging innovation, and so it has to be made aware to the people with the capital, so that the venture capitalists and private equity and so forth. Second challenge I see that's probably preventing some of the interest is it's maybe a perceived risk that the MNOs or the ANMs, as you coined it, really control those networks. And I think the question from a lot of investors will be, why aren't they doing it themselves? And again, I say it's a perceived risk because we've seen some of those MNOs try it, fail, and then onboard other companies and startups that are doing it better, and they're have a dedicated service. And I think related to that, the model is generally, I think you can come at it both ways. There's sort of the direct to consumer or direct to the agents, and then there's the sort of B2B to C model, where again, those MNOs, A&Ms are kind of the gatekeepers, and I think those business models in general are just a little bit more complex. And probably my final point, it was mentioned in the intro, how long is this opportunity going to last? And there was the comment, it's growing fast now, 27% compound annual growth rate. But how long will that last? Once we've moved from a cash-based society to more digital, what do these agents do? And I think there's a lot of opportunities for these agents to do other things, whether it's additional financial services, education. I think there are endless opportunities, but that still has to be proven.
Fantastic. I mean, thank you so much. Thank you so much. I mean, so some of these points are really interesting, and let's see during the course of this conversation today, if you're able to answer some of your questions. We have lenders and we have innovators in the agent lending space. So thanks again, Charlie. And with this, I come to the end of our first round of discussion. And before I begin the next round, where panelists will have more time to respond and maybe share some more of their experiences and talk about their products. I mean, I'll try and begin answering some of your concerns. I mean, Seth touched upon it, and then later on, Nitin and Abhinav also touched on it. So lending to agents is actually semi-secured because, as Seth's example of that, that e-commerce delivery agent, I mean, if you default, you no longer remain an agent, and I mean, you actually lose your sort of income and livelihood. So why would I default on that loan? That's one. But agents also deliver highly regulated financial service, and the loans involve inherent oversight from network managers and financial service providers. And then there is this excellent record of agents' transaction. Nitin was mentioning that he knows each and every transaction of an agent and their respective commissions. So, it creates an excellent data for lending decisions. And finally, lending, and I mean, we have been talking about it, but for the sake of repetition, I'll say it again. Lending to agents intends to expand their adjacent businesses. Lenders can de-risk and diversify, expand their portfolios to small and medium enterprises and also mass market space. And we also actually heard of some of the innovations in that direction too. But I'll move to the next round, and I'll begin with Abhinav. So Abhinav, you talked about your business and it folks and how you have used data. You assume the risk of lending because of your proprietary credit decision system that allows you to assess credit worthiness of an agent. Can you talk us through how you envision the future of Echo's lending to agents business? And it may partly answer Charlie's last question too. And of course, I mean, do you see a role of funding or investor support in your plans?
Sorry, the second part is a touchy one, but I certainly try and give my perspective to that. But coming to the first part of the question, I think we've gone through a full circle, and I think we continue to learn. And just to kind of simplify it for the listeners here, as far as Echo's underwriting is concerned, it's fundamentally divided into three parts. One is the personal information. The second is the transaction data. And third is the engagement data. And this is where let me just spend another 30 seconds. For instance, the agent is able to access our platform on the desktop as well as on the mobile phone. There are multiple notifications that go out. There are multiple videos which are present on the application. There are multiple products out there, right? So apart from just the pure transaction that the agent does, there are multiple other digital footprint which the agent is generating on the app. And I think there is a fundamental correlation between the engagement that a particular agent is having on the platform to the likelihood of that agent to continue to engage with the platform, even if that agent, let's say, is not earning substantial money on the platform right now. So three parts of this: personal information, which is really one of the important information is PAN card, and over a period of time, we have started, or at least contemplating of doing a bureau check as well. Not necessarily it is something that is a decision making point, but certainly is one more data add on to the decisioning. So one is the personal information, the second is the transaction information, and third is the engagement data or the digital footprint which the agent is generating on the platform. Through these, what we do is we kind of segment the agent, we kind of create different segmentation of the agent, and thereafter, so we have, based on these data, there is a segmentation algorithm which runs, and post the segmentation algorithm, there is a line assignment algorithm which runs, and line assignment is really different for all the different kind of credit products. That's really how the tech stack is currently built. I hope I'm now answering your question, at least on the first part. If I take a couple of minutes for the second part, certainly, as far as funding needs of this space is concerned, it certainly needs a lot. Now let me share something with you. As far as our imagination of a neobank, right? Our imagination of a neobank is probably an app in the hands of the end consumer, right? Once neobank became a term that was getting popular in India, I also started to talk to a lot of stakeholders and said that the business correspondent industry or the mobile money industry was the first neobank in India, because we were the ones who redefined banking. What is neobank? Think about it, right? There is a bank which has a mobile banking application, and you kind of create a superior experience for a certain cohort of customer, right? Now, for the customers, let's say for State Bank of India or any of the banks that I kind of work or Echo kind of works with, we redefine the experience of banking for a certain cohort of customers who are typically categorized as underbanked, unbanked, or people in the informal economy, etc. Right? Most of the neobanks are currently looking at customers who are fully digital. At least that's been the trend in India, right? And all so Echo and the entire other operators in India, and I kind of would like to make the statement on behalf of each one of them. I think we were the first neobanks in the country who defined a new experience of banking, of how to open a bank account, how to put money into a bank account, how to take money out of the bank account, how to remit money out of the bank account, including recurring deposits and fixed deposits, etc. For a particular cohort of the customers. We really fought hard. We went to the banks in India and asked them for APIs. When the bank said, hey, what are APIs? Today, there are banks claiming that they have more than 250 APIs, and it is easy to create a neobank in India right now. So my concluding remarks and on the lighter side, I kind of really say that we've really been the freedom fighters here. We've really fought hard for this space. We've really fought hard for the banks to understand what APIs were all about. And it is really the generation 2 or generation 3 of entrepreneurs who are creating the neobanks today and getting all the beautiful valuations. And I think the battle was fought with the banks about 10 years back. And it is, and while there are beautiful solutions being built on those APIs right now, but I think this sector needs its redemption as well. And probably Charlie is right that this is an innovation which is not happening in the West. It's an innovation which we are bringing to the world, right? And probably lot of investors, who have a greater experience in looking at innovation in the West first and kind of looking at what are the similar innovations and therefore funding. That's a very, very nice perspective, and that's probably the right perspective to have. But I think that's one more freedom fight that we need to make. That this is an innovation where we fought the battle really hard in India. This space is a lot older. This space is touching the lives of a lot more people than all the neobanks put together in India at this point in time, but probably has fraction of funding. Probably this is true even in Africa. And I would just take this stage to say that this sector needs the support of investors 100 times more, because I think the problem that we are solving is super, super, super hard.
Thank you so much, Abhinav. Yeah, I can totally relate to the freedom fighters with the bank. I mean, with the discussions on APIs with the banks and how you guys were able to manage it. So yeah, I mean, I'm completely aligned. But I'll move on to the discussion. And I mean, I'll turn to Jude. And it was interesting, Jude, when you said that you already are having knock on the door. Could you talk? I mean, you're seeing perhaps a very unique model of agent lending and a straightforward credit product for agents. You described it as well. Would you like to share some views on the replicability of this model? And then those who are knocking the doors, are they in different geographies or different type of players? And whether, I mean, and if you think of replicability of this model, how it will vary within that country or within two other geographies?
Thank you very much. Thank you very much. Pretty much the previous speaker talked about the banking and how it's changing. And I agree with him. It's no more banking of brick and mortar. It's now more of digital transformation banking. Now, in terms of this product we are having with Airtel, already we have some, of course, fintechs knocking on the door if they can partnership with them. The other MNO which is on, which we are still in talks to conclude it, is MTN. So if we get MTN on, it will be much better. So the beauty about the product is that at least it can does a pre-scoring of the agents in the different areas. So we get pre-formed data before with the partnership we have, and then the agent is already pre-scored, and the agent can easily tell his limit when he goes there the first time, if he has a payable limit, what he qualifies for. And when he gets that limit, he can be able to use it into running the business in another way around. So that's the pretty beauty about it. The other issues to consider is that, as banks, we are regulated by central banks. So there's a regulatory-ish bit of it in that direction. So with the regulator giving a go-ahead, the first time, if a regulator has not bought into transferring from brick and mortar to digital, it becomes hard to implement. Now banks have, especially in Uganda, have now moved on because the regulator is already on the board. So moving into the different geographical locations is pretty easy to move into the different geographical locations, especially in Uganda, as long as we have the central bank just backing us up. We find the number of agents, if you go in the remote areas, the agents are not as many as in the central area. So most of the reason why in the remote areas you find scarcity is because of capital. So with the financial inclusion taking place, spearheaded by the central bank, this model of lending on mobile to agents is quite will be coming in handy. And if you get the second MNO on, which is that's MTN, which has got a number of variety of agents around the country, I think we shall be able to move a milestone in that direction.
Thank you, Jude. Thank you for sharing your experiences. Interesting to also know who is the other MNO knocking the door. I hope this works out. Agents do need credit. Just to highlight, some aspects from our report. In a way, both the ECO and KCB Uganda models could be defined as a partnership-based lending, where agent networks have partnered with lender to offer credit to agents. And these models have inherent advantages like complete visibility of agents' cash flow, which de-risk the lending model. I'll turn now to George. And George, I mentioned earlier about your pilot, with of a credit product for agents. Could you help us understand the results of the pilot? What tweaks did you have to make to the credit product to match the needs of the agents?
Yeah. Thanks, Akkad, for the question, and really appreciate the panelists for the insights that are coming on board. So Asante Financial Services Group, maybe to just give a brief overview of who we are. We are currently present in 4 countries in Africa. We are present in Kenya, Uganda, Rwanda, and Nigeria. Now, the way we do our business is that we start with a partnership, do a pilot, for some 3 to 6 months. We acquire some learnings, to test our assumptions. From there, we are able to fine tune or tweak or modify the product that we take to the market before we can say we are comfortable to launch, commercially. So this model helps us a lot to, have some small exposure based on the business appetite, risk appetite for that experimentation. So in Kenya, for example, we've run pilots on agent financing, and one is actually commercially live as we speak over the last 1 year. And it went live because we were able to ascertain that our assumptions are correct, and we were able to ascertain that we are actually satisfying a need in the market. Now, I can say for sure that the pilot was a success, okay? And that's why we were able to go to commercial launch for one of them. And the other one is in progress. And the beauty of this is that whatever learnings and experiences we acquired in these pilots, we are able to replicate the same across our geographies. That is the other 3 countries that you operate in. And I'd like to just give an overview of how these Kiko agents operate for maybe the investors in the room to understand why it is necessary to have financing to support Kiko agents. Now, I'll use a typical example that is very clear in a Kenyan context. So a Kenyan will want to deposit cash on their M-Pesa wallet, okay? And we have thousands upon thousands of agents across the country. And, it could be a Friday evening, it could be a weekend, it could be early in the morning, where this customer has visited an agent's shop with some 10,000 shillings, which is equivalent of, say, $100 or thereabout. And the agent does not have enough e-value to satisfy this demand. So what the agent will tell the customer is that, sorry, I have no float. I'm not able to fulfill this transaction. So basically, actually building on Seth's explanation or story is that you turn away a customer who would have deposited cash from hard currency into e-value, used it in some bar and restaurant or in a cafe to take some coffee, or maybe bought some stuff online, right? Now, with this failed fulfillment of a demand comes a frustrated customer who might not have options to get this e-value converted for them to be able to fulfill the other transaction, whether it's even sending money across to a friend of theirs across the country. Now, what you are experimenting and what you are piloting is to see that we are able to satisfy that need at the right time, and also be sure that this money does not get diverted, okay? So that we know when the agent is getting this float, it is actually float to satisfy a deposit transaction. So what do? This agent that has only, like, say, $50 remaining, and the customer wants to deposit some $100, as a Santi, we provide the opportunity for the agent not to take $100, but only to take the $50 that is required to fulfill that transaction. In that case, you know that for sure, this transaction went through to satisfy that particular need at that point. Then we also allow this particular agent to access multiple of these transactions, okay, so that they can be able to satisfy that need. Now, what that means is that the agent is in a position to repay following the next customer's transaction, which could be now a cash out transaction. Because basically what happens is a cash in transaction or deposit transaction is a customer who comes with hard currency to convert into e-value. But the cash out transaction is actually customer who has e-value, but they need hard currency. So that e-value that is transacted by the cash out customer is useful to repay the money that the agent had borrowed from Asante Finance. So these were the cases that we were experimenting with, and we were able to determine on the product construct that we need to work with and we need to replicate. Now, when I'm talking about the learnings and the experience that we've acquired that can be replicable, is that the pilot has enabled us now to engage the MNOs. These are the mobile network operators, or what you're calling now the ANMs, to get in the journey. As Asante, now we are pursuing partnerships with these telcos where we get in the journey, okay, of the cash-in transaction, such that the agent does not have to apply for a facility outside the transaction, get the float into their e-value so that now they can transact. But the financing happens in flight or on the fly. And this is where we are getting into, and we are actually working with the telcos to tweak their systems in partnership with their vendors to be able to get this in-flight transaction capability, okay? So that at the time the customer is asking for the deposit, the agent will actually initiate the transaction of $100. And then in real time, the system checks the agent's balance and determines that this agent has insufficient float to fulfill the transaction. But now they prompt the agent to accept, a facility from Asante so that they can fulfill the transaction. So once they accept that facility injection by Asante, the transaction is completed. So the customer, in front of that agent, does not even understand that there's any delay, because it's a matter of seconds or microseconds that is happening, and it is happening in real time. In that sense, as Asante, we are sure that this transaction is getting to service the need that it is intended for. Then we also get into the journey of the deposit, or rather the cash out transaction, where when there is a cash out transaction, that's the conversion of e-value into the agent's wallet and giving hard currency to the customer. There is also Asante in the middle to sniff and understand whether this agent has an outstanding amount to be repaid. So instead of waiting for the agent to initiate the transaction to repay, we get in the middle, in flight of that transaction, and take off, or deduct the $50 that we had financed this particular agent, and they continue their transactions. So by the end of the day, all the agents needs to do is not actually to like deposit cash into some wallet and pay us. They just need to fund their wallet, at any given time, and the transactions proceed seamlessly. Now, the need is huge. I can tell you for a fact, this need is huge. We've seen the demand, just from the pilot. And that's why we decided that we need to get to the operators to change the model, and so that we are certain we are able to fulfill this need. Now, the element of decisioning, the element of decision making, we have a superb and robust in-house machine learning model, which is a internal proprietary system, where we're able to make decisions in near real time. We're able to tap into these transactions and analyze, on the fly. And the beauty of this is that every time agents are carrying out transactions, we feed that into the system to continue learning and continue making decisions, so that, if we're able to give you as an agent a limit of, say, $250, maybe tomorrow your limit could be $300 based on transaction level and based on your need. So in a nutshell, I can say that we are sitting on a pretty huge opportunity that if exploited, we'll be able to support the agent network, and in essence open up all these other opportunities that Seth talked about. The moment you convert this hard currency into e-value without necessarily getting out, we are supporting the mobile money ecosystem and agency network.
Yeah,
thank
you. Thank you, George, for outlining digital credit products for merchants and actually getting into the nuts and bolts of how you tweak the products. We'll turn to Nitin now to understand some of the risks in this business and also from an investor perspective. So Nitin, what are the risks in the case of direct lending to agents, and how can a lender ensure portfolio quality? Also, from an investment perspective, what key concerns or blind spots do investors have around independent lenders for Kiko agents? And sorry, Nitin, before you come in, there are some great questions I can see on Q&A. So I'll encourage fellow panelists to also try and see if they would like to respond to them. Sorry, Nitin, please, all yours.
Yeah. Before I start, I by mistake said that I will answer something live. So I was trying to type the answer, but I typed the long one. So Brooke asked, how do we get the repayment? So we ask the agents to repay, so they intentionally repay. So it's not like we debit it from their balance. So yeah, now coming back to what you asked, which are the inherent risks, like how do we address the risks? Right? Yeah. So that is where we kind of act as microfinance institutions, and we use the principles that we learned from the microfinance, which is how do you keep, and George is also in the room, so he knows what I mean by that. So how do we keep the customers, they keep repaying, because there's always a chance that they will grow, right? When our customers start at somewhere around $150 with us, and they grow, they get up to $1,200, right? So and this graduation happens based on how many times they've paid on time, right? And because we can even, so on the system, we even track even if they are late for a day, right? And everything goes into their risk profile, and based on which it is determined whether they will grow to the higher size or not. So that is how we hire risk. The second way how we hire risk is through the perfect product design, right? The advantage that we have on our side, especially when we are doing agent lending, is we have so much data based on which we can actually customize the product that they need and design a product which is specifically suited for that particular agent, as Abhinav was saying, for that particular agent, for that particular ecosystem, right? And that is where so I think and we all know how based on microfinance, where what used to let people not pay. Usually it's either you don't have people on the ground. So we So we also have like a full force on the ground. So we are not digital only lender. We have a team of relationship managers with a mobile app on which they get suggestions on which customers they should visit. Okay, and there is a proper risk profiling of every single customer that is done on the system based on how many times they repay. And based on that risk profiling, we suggest, okay, this particular customer, you should visit this often, right? So on their app, every morning they get a calendar where there are suggestions on which customers they should visit. So we visit these customers regularly. There is a big relationship management involved. There is a big element of the growth of loan involved, and then there, of course, it's like just being in touch with the customer. So that is how we manage our risk, and it has been extremely good till now. And also the product design, which I think product design is always kind of not considered, but it is one of the most important element of ensuring that people always pay. If you give them exactly what they need based on the business, then yeah, there is high chance that they will always pay back because they're using it for the business, not for anything else. Now coming on to the investors' blind spots. I don't want to kind of offend anyone, but like when you go and try to raise money, the challenges that you face are completely, you will be like, okay. So like, just as an example for us, someone like us, we are stuck somewhere between a fintech and a lender, okay? And so there are investors who want to invest in fintech, there are investors who want to invest in lenders or MFI, microfinance institutions. Now, when you look at it as a fintech, then they say, why do you have a book? Because we lend, we are a lending fintech. Yeah. So then, yeah, they don't want to take risk on the book, right? Then there are other type of lenders who want to invest in the microfinance institution, and we are too small for that because the only metric that they look at is the size of the book, right? And obviously, although the turnover that we have is very high because of terms of the loans that we have, the size is still small because we are small right now. We small, not small, based on the numbers that we have, but yeah, small in comparison to a lot of other microfinance institutions that are already there and have a much larger book. So this is one of the challenge that we faced when we kind of try to raise money on this. And they don't, and also I think where investors should look at is how like it's not secured just because there is an ability that you can switch off the line and all that. It's secured because the lending decisions are based on very hard data of the business, right? I can see every single transaction based on which I design my product, based on which I decide whether I want to lend to this agent or not. Not even banks have that kind of information on businesses when they lend to big businesses, right? But these small businesses have so much information sitting based on which we can make these lending decisions. So this is a perfect way to, this is one of the best segments to lend.
Thanks. Thank you, Nitin, for explaining the risks part and also the blind spots for the investors. I mean, I have a very similar question for Charlie. I mean, Charlie, what information and market awareness gaps needs to be addressed? We have heard a lot in terms of opportunities today, and you have also presented your viewpoint. I mean, considering all of it, what information and market awareness gaps needs to be addressed to ensure that more investors participate in this sector?
Yeah, I guess at this stage it's probably just the awareness part that needs to be worked on, because ultimately without the awareness, you don't have investors looking at this as an opportunity set and sort of screening the universe and screening the different markets for these opportunities. I think the nuts and bolts and the nitty gritty details you get into when you start due diligencing the company. So I think at this stage, it's really just that awareness piece that I touched on before, and where I guess in this case, the first mover advantage is not necessarily an advantage because you have to educate so much. And I think what you guys have done with this report is a fantastic step. I imagine we'll see that those numbers in that report quoted quite frequently in the next few years with, startups working in this space and trying to have sort of top-down market sizing in their pitch decks. So I think it'll be a great opportunity for people to understand the market better. I think the only other way we can expect the awareness to change is going to be through success stories. And right now, I think it's just natural that we're at the early end of this story. Hopefully it's a very successful story and there will be a number of successes, but the companies we've backed, you mentioned a couple in your report, so Pezesha and Kunda, both of them are just raising or have just raised Series A. So, we're still at a fairly early stage in the spectrum of growth. So I think that's where we're going to really see the awareness and the perception changes when you do start to have companies that have raised 50 million or 100 million, and the numbers start to attract the interest of the people that Nitin was maybe just mentioning, some of their impact investors or later stage VCs or PE firms, or whether it's debt or equity. They're all in the business of managing billions, and until we get businesses up to that scale where you can really start deploying 10 million checks, 50 million checks, that's always going to remain as sort of on the periphery, and maybe people are looking at it but not necessarily committing capital. That's obviously our role. We're an early stage VC, and this is the whole point, is to be catalytic and to help these early stage businesses get to that stage where we can start to see more awareness and more capital flowing in.
Thank you, Charlie. We have very little time left, and there are some very interesting questions. So what I can promise is we have taken note of the questions. We will be in touch with our panelists and try and respond to these questions. But I would like to pick one question, and that's very interesting. It's not about the scoring or how the repayments are made, but very interestingly, this question is: do we see any behavioral differences into between the men and the women agents that we lend to? So this is for all Jude, George, Nitin, and Abhinav. If you get, we are nearing the closures, but if you can take 20-30 seconds to answer this question, that will be great, and then I'll hand it over to Anup for closure.
Yeah, in terms of is there any difference? The difference is more in terms of the challenge that they have, like in terms of how difficult it is for women agents to access this capital compared to a male agent, right? The difference is not in terms of how they use the funds; they use it for the business anyway. Right? We were trying to. I started my career with a women-only microfinance institution, so I am always interested to see how they use it. But we have looked into data; it doesn't tell us they use it differently, right? But it does tell us that they need it more than the other agents, because that what you need to get credit is the usual credit, conventional credit that is available in the market. They usually don't have that. And they need this capital more than the other agents, because they definitely don't have access to credit. And we have seen the agents, so we have 46% of our customers are female agents, right? And and we have seen when we go and talk to them, it's just, first of all, it's better to see that they have grown so much, and they really appreciate the value that we bring as a lender, and we have added to their business.
Thank you, Nitin. Any other panelists would like to quickly react to this question?
Yeah, maybe I can react quickly, Akad. So there's something that technology did to level the playing field across these micro and small enterprises, in that as long as the access channels are the same, and digital financial service providers have access to this information to make decisions without any bias, will be able to come up with the same, kind of results. Actually, what happens is that we have some sectors, these are the adjacent businesses to Kiko, where you see mainly being run by women. Other sectors, you see businesses mainly run by men. So if you are to only concentrate on a particular sector, you might be misguided to think that women are better performers, but it's only because you are looking at a particular sector. So I think the digital platforms and technology has leveled the field to really ensure that both female and male genders have equal opportunities. So I think that's a key thing, to just make sure that all of them have equal chance of accessing technology, so that we're able to score them fairly and in the same or similar way to be able to access financing.
Yeah, and then their access is something what Nathan also pointed out. Okay, thank you so much. We are already over a minute in this webinar. A big thanks to our esteemed guests, Abhinav, George, Jude, Charlie, and Nathan, for taking out time for us today and sharing your valuable experiences. I'll now hand it over to Anup to conclude it.
Thank you so much. So first of all, thanks to all these speakers, moderator, facilitator, panelists, and participants for making this session very enlightening. There were some fascinating points and examples which were discussed in the session. I'll use this opportunity to debrief on some of the issues that were discussed. So the transaction failures, which is roughly around 20% due to lack of cash, it impacts the user's trust in digital financial services ecosystems. Talked about how providers are willing to put up more agents in new locations based on the historical data on transactions and fees and customer behavior, but they cannot do so because of the lack of initial capital. Also, we heard that the current and potential new agents can make money through transactions and from the adjacent businesses, benefiting from the increased footfall that happens to their agency point. Thus, lending to agents present an authentic investment thesis. Also, lending to agent ensures the health of digital ecosystem. And there are unmet credit needs of the 18.5 million agents across various markets. And we also heard from the panelists and from the speakers that the agents play an important role in lubricating the economic engines. We heard from Abhinav talking about how understanding agent behaviors enables providers to develop products and services for them, how all the agents are trying to solve the same problem, but there needs to be customization for the solutions. Agents are generating digital footprint that lenders can leverage to assess their financial behavior, also to lend to their adjacent businesses. And Nitin did talk about how they have been utilizing data to enable hyper customization of financial services for the agents. Nitin also did discuss about the need to have elements of touch embedded in the delivery of financial services. Then we heard from both Jude and George about traditional financial institutions, how they are now beginning to understand the business case of lending and how fintechs and MNOs are looking for partners. However, they agreed that innovations in this space are much slower. Abhinav did talk about investor support that will help catalyze the agent lending space. Then lastly, we heard that there are regulatory limitations that constrain innovations in agent network management and lending space. And from the investor perspective, so Charlie did talk about quite a number of aspects, like investors need to be aware of the leapfrogging innovations, but also need to be aware about how long this opportunity is going to last once we have moved entirely to a digital society. And then one point which I'm taking away from the conversations is from an investor's point is that awareness of the business potential is a first step in encouraging investors as well as the fintechs to consider agent lending. And the other way to enhance awareness is through the success stories that we are seeing. And ultimately, there are endless opportunities, but these need to be proven for investment. So thank you so much for such great and very insightful discussion. We encourage you all, the participants and the speakers and panelists, to go through our report and do provide us with the feedback. We do believe that there's a lot of potential in agent lending. Thank you everyone for attending this session.